Hey, Market Chameleons. Thanks for joining us for today's webinar on the long call options screener. D,
Hey everyone.
we're only YouTube live right now. There are probably 5 or 6 people joining us on YouTube live. I'm
Sure.
gonna launch the Zoom meeting right now. We'll start the Zoom meeting. You ready, buddy?
Yeah, let's go.
All right. Welcome everyone on Zoom. We will start the webinar with Dmitry's discussion on the long call option screener in a couple minutes. A few ground rules. Leave all your questions on the Zoom in the Q&A, and D will get to them hopefully at the end of the episode. If it's something super relevant, I'll try to get it to him right away. But tonight's episode is going to be on the long call option screener, something that was newly launched by the Market Chameleon community. Well, actually, that is Dmitry launched this. This is his idea, and it is a great screener for ideas. Thanks for giving it to us, D.
Yep, thank you. Well, it came from a lot of requests from people in the community. So, I tried to initially we started out, just so everybody knows, looking at spread screeners, so call spreads, put spreads, because I think that just in general, spread screeners offer better risk reward when you're trading, when you're trading even directional, or it allows you to get a little bit better probability and success rates. But a lot of people, they do like just the simple buy, call, buy, put. They've been asking for a long time. So we finally created a long call spread screener, and a long just single buy call or long buy put screener. So today we'll just do the call screener. The put will be just basically the same thing in reverse.
Awesome. So with that, let's do the disclaimer first. Is that okay? If we go to the disclaimer?
Yep. So before we get started, everyone, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your registered investment advisor or call your broker. They should be able to help answer your questions or provide you with guidance. There's the disclaimer, everyone.
All right, so we have a bunch of people on the chat. So if you're on the YouTube chat live, please put any questions in the chat. Now, for anyone who doesn't know, we do a morning show live every morning, 9 to 9:30, and that is during the week, only during market hours. That's correct, right, D? Every morning during the market hours.
Every morning, Monday to Friday. And actually, tomorrow morning, I'll discuss a new feature we launched. I didn't even realize we launched it this weekend, and that's the post earnings drift. So we'll talk about that tomorrow morning, stocks and their historical post earnings drift. But let's leave that till tomorrow.
All right.
Today, we'll do that long call option screener. So this is looking to screen for call option opportunities from the buy side. Okay, so this is just looking from the buy side. And right now, when we have the screener set up over here, when we're looking at calls, so this over here, this long call details, this is the option where we're looking at the expiration, the strike, the delta, and this here, where we're going to be looking at is the call ask price. So not the bid price, not the midpoint. We're looking at from the perspective if you bought the call on the ask. Okay, so before we get into it, let me just go really quickly over. I just made a few notes what we want to cover today. So let me do this presentation really quickly. How do I do this? Present. All right, so this is what we're going to cover today. We're going to use that call option screener. We're going to do a few different examples. We're going to look at a call's theoretical edge. How do we screen by theoretical edge? Then we're going to look at a call and screen by unusual option volume. And this will be a little bit different than like the unusual option report that you guys have probably been used to, where you're looking at in aggregate. We're going to look at unusual option volume in a particular option. We're also going to look at a screen for looking for concentration of open interest. So this would take a look at, it could have volume today or not volume today, but we're going to look at where there are calls where there's a lot of open interest on that line on a relative basis. And then we're going to do another screen, seasonality play. And there I'm going to use one of the payoff, you're going to see one of the payoff filters to screen for the best seasonality plays. So I'm going to try to cover all 4 of these today. And along the way, we're going to try to take some questions. If there are questions, let me know. Or you want to stop me or at the end, and we'll take questions on this screener.
Sure thing,
so
friend.
We talk a lot about theoretical edge, and that's the one thing I'm just going to really briefly go over. What does that mean when we're looking at a call now? Of course, if you're buying a call and you're not hedging it, you're just buying the call, and you really need the stock to go up, right, to make money, because that's why you're buying the call. And if you don't really have an good reason for the stock to go either up or down, a theoretical edge is basically a probability bet. You're looking at, this is a good probability of making money. That's why I'm taking a bet. And most traders, that's what they'll look at, because there's no real, you might have an inkling where it might go or not go, but a lot of traders also would want that theoretical edge to see if they're getting a good deal or the probability is on their side. So in this example, we're going to look at theoretical edge from a historical odds perspective. So what is really quickly, I'm just going to do a theoretical edge example. And down here, let's say you have a call option, right? And the call option, I'm looking at the left, let me do a pointer here. So let's say these are the details right here of what the call option is. So let's say we know that the call option strike is $110. Let's say we know that the stock price is 100. So this call is out of the money, right? 10% out of the money. And there's 10 days to expiration. So we really don't know, just looking at this, we don't know what the value of that option should be. And how much should we pay for it? Is it high? Is it low? And we don't have any idea. Let's say we don't really have any good reason to believe that the stock is going to be up in 10 days or down in 10 days. So one thing we could look at is, well, what do we think the value of this option should be? And so let's take a look at a distribution of returns. And let's assume, now I'm going to go to the right, and that this is how the distribution of returns look like in this particular stock after 10 days. So really what we're interested in is, where is this stock going to be at the end of 10 days at expiration? So let's say we look at history and we say, well, half the time, 50% of the time, the stock is up 15%. Okay, so 50% of the time, the stock is up 15%. Sorry, let me just get that. And then the other 50% of the time, the stock finishes below up 10%. Okay, so why is that significant? So let's take a look here. If it's up 15%, right? So the stock right now is 100. If it goes up 15%, the stock will finish $115. So if the stock finishes $115 at the end of 10 trading days, then this call, the 110 call, will be worth $5, right? We could exercise our call for 110. We could sell the stock for 115. So that's a $5 spread. This call will be worth $5 if the stock goes up to 115. If the stock is below this 10%, it doesn't increase by 10%, it increases by 1%, 2%, 3%, or it goes down, then this option will be worthless at expiration, because if the stock is 109, 108, 107, this 110 call, you're not going to exercise it. You don't need to buy the stock. You don't need to exercise it and buy the stock at 110 if you could get it in the market below 110. If you could buy it at 109, this call is worthless. So if we have, let's just assume this simple scenario, right? Just this simple scenario here. What is this call worth? Well, if 50% of the time we think the stock will be 115, then we think 50% of the time this call will be worth $5. This is the theo. And 50% of the time the stock is below this threshold of, it won't go up by 10%, more than 10%, then this 50% of the time this will be worth $0. So over a long period of time, if we did this trade over and over and over again, if we use this as our model, then 50% of the time times 5 plus 50% of the times 0. This option in a long term is worth on average $2.50. So what's a theoretical edge? Well, if I could buy the option for $1, and I think it's worth $2.50 in a long term, well, that's theoretical edge because I'm getting it below its theoretical value before its average, fair value or whatever you want to call it. If I'm buying it for $2, I'm still buying it below where it's theoretically valued. Because if I could always buy for $2, half the time I'm going to lose $2. The other half the time it's going to be worth $5. I'm going to make $3. So in the long term, it will be profitable if I kept doing this trade over and over and over again. So this is a theoretical value, $2.50, and an edge would be if you could buy it below. That's considered kind of a good deal, and that's theoretically your edge, right? And in this example here, because I said 50% of the time it'll be up 15%, 50% of the time it will be below. My win rate is 50%. That means if I played it many times, right? If we use this distribution of returns and as true, that means that if I played it many times, 100 times, 50 times, the longer the period, I think that half the time this trade will be profitable, half the time this trade will not be profitable, and on average, then value is 250. Okay, so that's theoretical value. Now since we did that, let's take a look at a screen to look.
D, we're getting a quick question relative to theoretical value. They're asking the time, the number of years, months, days, years that are taken into consideration to calculate that thea.
Right, and that's a good question too. Now, right now we defaulted to 4 years of data. In the screener, you can change it to 6 years of data. You could change it to 2 years of data. Remember, after the screen, you could also go to the options chain and change it to any 1 year, 2 years, 3 years, 4 years, whatever you want. You also have the ability to massage that data based on where the implied volatility is. If it's earnings, it only uses earnings data. If it's not earnings, it excludes earnings. So it's doing all that for you within that screener and in that deal. But that's a good question. How many years does it? Now we defaulted to 4 years, and there's two different thought periods, right? Like, do you want to use more years, but the further you go out, the less relevant the data is? If you go to, like, for example, the last year, the more relevant the data is in their distribution of returns because the stock is reacting to circumstances that are more current. Okay, so I'll show you how that looks like. I'm gonna exit this. And here's the long call strategy screener. So this here, where is it? See here, historical distributions defaulted to 4 years. You could change it 2 years, 4 years, 6 years. Again, if you go to the options chain, it's just a screener. It's your starting point. You go to the options chain, you have much more flexibility, to do anything 1 year to 10 years. So let's stick with the 4 years right now. So here, right now, it's looking at, it's scanning all the different calls here and presenting them. So a lot of them, this is the market value. This is the theoretical value. So here we see that, well, if it's $1.21, theoretical value is 40 cents. Well, if I'm paying $1.21, it's like a negative theoretical edge. That means I'm actually paying up. And there's times you might want to do that. It's just you have to be aware you're paying up and and you might have a good reason. Like, for example, here, Apple, right now I'm hovering over this little C, and this is telling me that before October 16th expiration, Apple will have an event, October 13th. That's a special event. And maybe that special event could be a big catalyst for a big move. So there are times where you want to take into consideration and say, yes, like, even though I'm paying up, based on the historical, we could go look at it based on the historical data. Whenever Apple has this big event, 70% of the time Apple is up, 30% it's lower, but the 70% time it's up, it's really up, way more than average. So always keep that in mind, that look at all the other circumstances around your trade, not just, these are just statistics. These are just helping you out with statistics, but you still want to go do your research. So having said that, let's take a look. I'm going to, first, let's read this across just to see all the data that's on our summary page. And we're going to go over some of these different data views that you see up here in the tabs, but let's just be familiar with these. So this here, that's the stock symbol, that's Apple. This is where Apple closed at $124.50. Today, the stock was up 6.4%. This is its market cap, $2 trillion. This is looking at, so we're looking at this long call, October 16th expiration, the 130 call. It's a 26 delta. So you see it's $5.50 above the current spot price. The option is $1.21. Theoretical value that we just talked about, we think it's worth 40 cents. That's giving you a negative edge of 67.2%. Historically, if you did this trade for this price, $1.21, it would have been a winner 10.4% of the time. So it's looking at how often would the current market, based on the current market, how often, frequently, historically, did the stock move enough to make this price profitable? Okay, that's what it's looking at, this price, 10.4%. Historically, what's the probability of touch that at any given point between now and expiration, would this price, would the stock move enough to be in the money to make this price profitable? That's 19.1% of the time, probability of touch. So remember, we're not using the Black-Scholes or binomial, we're using actual returns. We're using the actual historical returns of Apple stock, okay? Binomial is a little bit different. That's looking at volatility and hedging. Black-Scholes, it's a little bit different. This is looking at just historical returns in Apple. Here we see that little C is just indicating that there's a company event coming up. This is telling us the implied volatility of this option. And this is telling us that the implied volatility was up 10.7% today on this option. Here, these are just stock indicators. So today, based on the moving average, we're not getting, it's not in an uptrend, downtrend. So far, we're not getting any kind of indicator. But what this is telling us is that today's price move of 6.4%, Apple broke its one-day resistance, basically made more than one standard deviation move to the upside. This is the option volume today in Apple. In this option, the October 16th 130 call, and this is a relative volume. This is saying that today's option volume in this option represents 14.4% of the average daily option volume in aggregate. So if we added up all the options, all the calls, all the puts, every strike, every expiration, if we added all those up, daily average, just this volume alone in this contract was 14.4% of the average daily option volume in aggregate. Okay, so we're going to use that later, but I wanted to show you really quickly what all this means. So let's do a screen right now. Since we're talking about theoretical edge, let's do our first screen looking for positive theoretical edge, okay? So I'm going to do this. First, this is defaulted to the October 16th expiration, the next monthly, but I'm going to expand that and say, show me all the expirations that are expiring in the next 30 days. So not just October 16th, but anything that's expiring in the next 30 days. So if it's this week, it will include it in there. If it's, so you see here, October 23rd, October 30th, October 16th, it's in there. So it's going to include all these, October 12th, 14th, 16th, anything expiring within the next 30 days. So this way we could scan, we're going to expand our scan. Now, what we want to do is say, all right, let's take a look for positive theoretical edge. So at first, I just want to see any option that's trading below that theoretical value, or its historical average. So I'm going to go here, theoretical edge, and I'm going to say we could set this, any positive, above 5%, 10%. So let's just do any positive. So we don't want any negative ones, but it has to be at least a little bit positive. So we see here, right away, it's still produced a lot of them just in Apple alone. So just in Apple alone, we got a bunch of them, and the reason Apple are showing up everywhere here is this is auto sorted by market cap. So it starts out by market cap. So we see here that everywhere, Apple, Apple, Apple. So let's just take a look at the best one per stock, right? I just want to see the best theoretical edge for Apple and then go to the next stock, show me the best one for that. If it's Microsoft, show me that. So that's what we want to do. We want to scan the entire market really quickly and bring that back, right? Of course, you're never going to be able to do this by hand. You need machines, you need everything working in the background, constantly doing this so you could do it quickly. So let's see how quickly we could do that. And we're going to say, show me the best one by theoretical edge. So right now, I have 3 filters, everything expiring next 30 days, a positive theoretical edge, and the best one by Theo. So we see in Apple, here's what it found. November 6th expiration, the 119 call, the option is $9.40. We think it's worth $13.41. That's giving you a 42.6% theoretical edge with a historical win rate of 68.8%. Now, one thing I'm noticing here is not only is there going to be a company event, there's going to be an earnings. So if you open that up, it's actually only looking, here's the data, it's only looking historically for earnings periods. So see 16 in the last 4 years, 16. So it's only looking where the historical data covered an earnings period, and it straddles from today to expiration, straddles it the same way it is doing it now. Okay, so that's what it's doing here. Amazon, we could see here, it picked out the October 23rd. Yep.
Before you jump to Amazon, Steve Maxey was asking a question about win rate with the Apple when you were describing Apple. I missed it, but maybe while you were there, it's still fresh. He's asking, is the win rate calculated against the past 4 years of Apple stock price compared to the option? In this case, the October 2020 130 call.
With the October.
He's asking, I guess, how the win rate's calculated. You were given an app. You were given an Apple. He's asking how that's calculated.
So the win rate is basically calculated like this. So over here, you see we have 68.8%. So let's take a look at it. Let me move this around a little bit because I have stuff on my screen. So over here, this is what the call would look like. The call, we're looking at the 119 call. The option is $9.40, right? The stock is $124.50. There's going to be dividend in there, so this is adjusting it for the dividend. 19 trading days to expiration. So this is what we know, that if the stock is below 119, right, below 119, that means this stock or negative 4.3% from today's price or lower, from this price, 124.30. If it falls by negative 4.3% or more at expiration, this call is worthless. It's zero because the stock will be below 119. If the stock, let's do this, above 128.40, okay? So if the stock increases by more than above $128.40, right, or more than 940, then at expiration, this option will have a value, right? It'll be profitable, actually. This is saying that this is above your break even, right? More than 3.3%. So if it increases by more than 3.3%, this option will be profitable depending how high it will go. If it's somewhere between 119 and 128.40, then this option will be worth, or in this range, between negative 4.3% to positive 3.3%. Then this option will be worth anywhere between $0 to $9.40, depending where it lands, right? So if it lands at $120, this option will be worth $1, right? Because it's the 119 strike. If the stock is 121, this option will be worth $2 because it'll be $2 in the money. So anywhere in this band, negative 4.3% to positive 3.3%, it'll be worth anywhere between 0 to 940, but it'll still be a loss. So our question is, how frequently does this happen? This goes to Steve's question. Well, how frequently, right, does the stock go up by more than 3.3% to make this option profitable? Because that's our break even, 3.3%. So this is what it's doing. Now, remember, this is looking only at earnings. So between August 7th to July 13th to August 7th, which covered in earnings, the stock was up 16.6%. If the stock does that again, this option will be worth $25.90. Okay, so if we increase 16.6% from today's price, this option will be worth $25.90 at expiration. Between April 13th and May 8th, again, it was another earnings, straddles earnings. The stock was up 13.8%. If Apple does that again, this option will be worth $22.45. So you could see that will be profitable too, right? That's above the 940. So it keeps doing that. So that's what this win rate is saying, that historically, how many times did the stock go above 3.3% in this similar scenario? That happens 69% of the time. Okay, 11 out of 16 times, 69% of the time for an average price of $18.25. Okay, 19% of the time, the stock finished in the money, but not enough, so it was a loser. So 19% of the time, on average, it was $4.58. 13% of the time, this option was worthless. It would be zero. So if we take 13% times zero, 9 plus 19% times 458 plus 69% times 1825, that's where we get this theoretical value, 1341. So the win rate, it's looking at this 940, saying how many times historically did it move percentage-wise enough to, it needs this 3.3% to make this profitable 69% of the time. That's this win rate. It rounded at 68.8. Does that help?
Yeah, that's super helpful. We did have a quick question from one of the great chameleons from Tyler, Texas, Mike. He was asking, if you see a negative theoretical edge on the buy call screener, does that mean if you sell it, you are doing it for positive theoretical edge?
Yeah, so well, I'm only looking right here at the ask side of the market, right? So you would have to compare it to the bid side. Okay, so like if the theoretical edge is $9.35 and the market is $9.30, $9.40, so it's right in between. It's fair value. So selling it at $9.30 doesn't give you a positive theoretical edge, and buying it at $9.40 doesn't give you a positive theoretical edge because it's worth $9.35. So you'd have to then compare it, like depending where you would do it. All right. So keep in mind, this is based on a statistical analysis, right? And you have to take other things into consideration, like what's different, what's going on, because obviously there could always be something different that's going on that you need to consider, right? Like, for example, if you have a biotech stock and tomorrow they're going to, the FDA is going to announce, if a drug's getting approved, and it's the first time that's ever happened, the historical data doesn't even matter, right? Because this could be like a make it or break it situation. So these are statistics helping you out, but you got to always read the news, and whatever else is going on around that stock, you have to go research and take all that stuff into consideration. So hopefully, that was helpful. Was there any other questions?
That's it for the moment.
Okay. So as you can see here, I'm just going to go just show you a couple other ones based on the theoretical edge, like over here, Amazon. This one, October 23rd, I'm not getting an E, so this isn't going to be in earnings, but it's looking at the October 23rd, 3,320 call. that option is $176.65. We think it's worth $218.24. Obviously this is a really high price stock, but that gives you a 23.5% theoretical edge with a historical win rate of 54.5%. So if you open this up, it'll explain it to you, but you could see here, in the last 4 years, 55 observations. This is the breakdown. Here's the data in that study. Okay. Microsoft, that was up 2.6% today. This one, it will cover in earnings because it has a little E there. October 23rd, it's looking at the 227.50 call. That option is $1.99. We think it's worth theoretically $3.77, giving you a theoretical edge 89.5% with the theoretical historical win rate 43.8%, and so on. So that's how you would do it, here. Now, if you wanted to narrow it down further, let's say you just want to see buyer watch list, you could just say, show me my watch list. I'm only interested in my big data watch list. So this is my watch list, like stocks involved in the big data. And then you could do it this way. So you have a lot of different choices here. Once you get your filters all set the way you want it, just save it, my big data Theo, and whatever, save it, give it any name you want, and it will be in your drop down next time you come back. Okay, so that's how you would do it. I'm gonna unselect this. Besides doing it in your watch list, of course, you could use some of these other underlying ideas, like screen for stocks just in the S&P 500, or let's say we want just the Dow Jones. So I'll look at holdings that are in the DIA. You could screen it this way for higher market cap stocks. Actually, these are just holdings in ETFs. So you could just pick an ETF that you like: energy, financial, SPY, QQQ. Screen it that way. If you wanted to do it by market cap, you could just say, give me stocks above 50 billion market cap. Or you could go look for lower cap stocks. Some people, instead of the higher cap stocks, they'll look for stocks that have potentially, lower market cap stocks could really move a lot. It doesn't take as much to move. So you could look at under 1 billion, right? Or even lower. Let's go under 500 million. So these are stocks with theoretical edge that market cap is lower than 500 million, right? You could do it that way. Let me unfilter this. You could also create a minimum of average option volume per day. You could look for stocks that are hitting new 52-week highs or lows. So 52-week highs, the idea is, let's say it's within, let me see. Sorry, this is the 52-week low. 52-week high, let's say it's within or above the 52-week high. So it's making new 52-week highs today. So Alibaba, TSMP. So these are stocks that are running, making 52-week highs. So some people play that. Other people play the other way and think like, well, if it's hitting a new 52-week low, maybe it'll have a bounce, and you could do that 52-week lows. So you have the ability to kind of just track really quickly and find call ideas based on like some technicals. Here's another technical. Let's just go over this one: stock ideas. Looking for market leaders, market laggers, or momentum stocks. So market leaders, these are stocks in the S&P 500 that are the most responsible for pushing that S&P 500 higher. And we talked about this before. The idea there is stick with the market leaders, because if they go down, the whole market's going to get pulled down with it. So these are the market leaders. So we got like Apple, Amazon, Microsoft, Google, all. Remember, I still have that set to positive theoretical edge. So that's these ideas. I don't think you want market laggers. Momentum stocks, these are stocks that are looking at, I think, 6 months, 3 months, 2 weeks, and those stocks are making higher lows and higher highs. So let's take a look at what a momentum stock looks like. So Alibaba, that popped up. Let's take a look at Alibaba and see what that means. when we screen for momentum stocks. So Alibaba here, one sec, I'm going to go to the summary. And here's the trading stats, right? So here's what Alibaba is doing. In the last 6 months, 3 months, you see the low for the 3 months, low for the 1 month, low for the 2 week, higher lows, right? Higher lows, higher highs. That's momentum. So that the idea behind that there's momentum behind the move, that there's strength, higher lows on the way up, higher highs. So that's momentum stocks. Here, I'm going to unscreen that. Option order flow. This is just how order flow in the options. Are they coming in more bullish or more bearish? You could do it this way. Moving indicator. This is, and you could read about this. There's a bunch of different ones. That's based on how the 50-day, 20-day, 250-day moving averages are crossed and how the stock is crossed around those moving averages. So you could read those, but if you're looking for an uptrend, basically everything is crossed in a bullish manner. So that's how an uptrend is. So the idea is if it's already in an uptrend, it's moving in that direction that you want. I'm going to unfilter that real quick. And this here is looking at, did it break today's 1-day support and resistance? So that's just looking at, when you're buying a call, you need the stock to move. So once it breaks, that one standard deviation, it's kind of already breaking above where it would be expected to trade, right? And it's kind of confirming that move, right? So if it's moving outside that one standard deviation, it's moving outside where you're expecting it to trade. So maybe that's building up on the move, to that upside. So that's really quickly different ways for underlying ideas. Let's come back here and go to the summary page. So now we looked at theoretical edge, best by theoretical edge. We could also add a win rate here. Steve was talking about that historically. I want it to be, be at least 60% of the time win rate. So you could do that. So then it'll scan for best theoretical edge with at least 60% historical win rate. So those are the things that you could do really quickly here. I'm going to uncheck this. So another thing we could look at, and I'm going to really quickly, I'm going to clear out all, unless there's questions on my filters, I'm going to clear out all the filters and do a completely different screen.
There's Gary has a quick question, and just so everyone knows about the data, he's asking, is it real time during the trading day? He wants to know about real time data.
Yeah. So the market data itself is on a 15-minute delay. And then first of all, when we're talking about real-time data and we're talking about options and stock, that there's literally millions of ticks within a second, many millions of ticks within a second. So there's no such thing. You will not be able to recalculate all these theos on every single tick. That would be impossible. You need to capture it, run the theos, produce the theos, and so that needs to run on some kind of a process. The other thing is we are only looking at 15-minute delayed data. We don't have a real-time market data feed, and we talked about that before, but we don't control the real-time market data. We lease our data from the exchanges. They control that, and the requirements around real-time market data, there are different requirements for real-time market data and delayed data, and those requirements, they interfere with their own service. So some of the things that you're seeing right now on your screen and the ability you're able to do, like have side-by-side screens, downloads, use different computers, we would not be able to offer that with real-time data because there's strict controls and restrictions in place. They don't want you to fan out any real-time data. So this is, again, 15-minute delay, the market data. When it goes into our database, it runs on a timer, produces the analytics. I mean, you could see like there's, hundreds of thousands of options that you have to run the analytics. And then it just continuously updates throughout the day that way. Hopefully that answers that real-time market data question.
Super helpful. Thanks, D.
Yep. So before I move on, let me clear out. We're going to do a completely different screen. So the next screen, let's look for unusual option volume in a specific option, right? So really, like maybe a lot of you use this unusual option volume screener. And this is looking for unusual option volume in the stock, right? So there's 13,563 options that traded in DDS, which is 11.6 times its average daily option volume. But let's screen for a specific option to see like where's there, you know, and we would have to go to the options chain here to figure out how that volume is distributed, and as if there's any concentration in a specific option. Like for example, DDS, I'd have to click on it just to show you how right now probably most people are doing it. So then I would say, like, okay, well, there's 5,700 contracts October 16th, 4,000 on January 15th. You know, these are the different expirations. So then on October 16th, I'd have to go and find, well, here's the most active option, 2,000. You know, let's make it easier and just screen for, you know, trying to find if this 2,000 contracts is unusual. That's what we're going to be trying to screen for in, actually, we're going to be doing it in the calls from the screener. So again, I'm going to go to look, I cleared the filters, so I'm going to do this filter again. I'm going to look for any expiration within the next 30 days. So I'm going to click on that. And then let's take a look at the different, so over here up top, we have different tabs for the filters. I'm going to go here, volume and open interest. So for the option volume, one thing I could do is just set a minimum, say I need at least 1,000 contracts to trade on that specific option, right? So this way, now you could see here, all these option volumes, they're over 1,000 contracts. But in Apple, maybe 4,000 contracts isn't that much, you know, or 3,000 contracts on any given line, it might not be that much. And for different stock, 3,000 could be a lot if it only trades, you know, on average 500 contracts a day. So that's what we want to see. What is the relative, how much of these, what is it relative to the average daily option volume? Okay, so let's say that I'm going to set that the option volume on that contract had to be at least, let's say 20% of the average daily option volume. Okay, so over here, we got one in Apple. Let's take a look. So Apple traded 308,156 contracts on the October 16th 125 strike. Well, what does that mean? Well, on average, let's take a look. On average, on an average day, Apple trades 3,880,035 contracts per day, right? So just on this one line, if it traded 308,000 contracts, that's 22%. That represents 22% of the average daily option volume in all the, and you could imagine if you go to Apple, they have hundreds of strikes, multiple expirations, you know, so lots of different calls and puts, so lots of different options there. So this one option alone represents 22% of the average daily option volume. So I'll just give you, just to give you a, let's take a visual, right? Let's take a visual on Apple. What this means, 22% just in this one contract, one line. If I go to the Apple options chain, see here, all these different expirations, October 16th, October 23rd, October 30th, November, all these different expirations out here. And if I click on any given expiration, you could see there's a volume, there's all these different strikes have calls, have puts, volume in all of these, right? Volume in all these calls, volume in all these puts. And I could go back to different expiration, volume in all these calls, volume in all these puts. So if we sum them up, you know, added them up on average, let's go back here. On average, it trades, what do we say, 3,300,000, or what was it again? 3.8 million. I'm sorry, not 3.8 million. That's today's. On average, it trades 1,397,000 contracts. Sorry, that's today's volume. The average daily option volume, 1.39 million. So that today's volume on that option contract alone is 22% of the average daily option volume. That's what that means. So that's what we're screening for, unusual option volume in a specific contract. So J&J, October 16th, the 155 call traded 13,031 contracts. That represents 37.9% of the average daily option volume.
They have earnings coming up, don't they?
They have earnings coming. That's what this E is. That's tomorrow before the market opens. So that's an earnings, and that might not be unusual, like right up against earnings. BHP, October 16th expiration, 52.5 strike, traded 1,709 contracts. That represents 100% of the average daily option volume, right? Here and so forth. So we could sort this, right? We could sort this by, actually, let's go higher. Let's go over 50%. So this is over 50%, and I'm going to do by option volume. So we could see here, 50,000 contracts in CLDR, up 3.8%. October 23rd expiration, the 12 call. We see the implied volatility was up 50%, most likely more buyers than sellers, and that represents 174% of the average daily option value. NET up 23% today. So looking at October 16th, 55 call, implied volatility up 123%, traded 19,957 contracts. That represents 109% of the average daily option volume. So you could see here really quickly, you could home in on the unusual option volume specific to the strike, okay, specific to that call option. Let's take it down a little bit more. Here, I'm gonna switch this tab here to the volume and open interest. Another thing we could see is that it traded a lot of volume, but on what was the average size, right? So the average size is if it trades a lot of volume and it trades a lot of different trades, then the average size could be small. Or it could trade a lot of volume on one trade. That means that one big trade or two big trades went in. So the average trade size will be much higher, right? So in this situation, CLDR, 50,187 contracts traded, but it also had 5,544 different trades. So that on average, that represents nine contracts per trade, right? So we could filter out by a lot, so we could say average size, above a certain amount or below a certain amount, like above 50, let's say. So over here, we see here that the average size, 110, 446, 471. So this is probably telling me not a lot, only four trades in that, on that contract for volume of 1,883. So most likely those were big trades, right? Somebody made some big trades. The other ones, those were distributed amongst many small trades. So many retail traders are jumping in, or whatever it is, many different traders are coming in, trading it throughout the day. That's what this is telling us, okay? The average size. So let's come back to the summary now. Now, what if we wanted to see that it had unusual option volume and more likely there are buyers than sellers? So we could do that by the implied volatility, right? And we could just say, show me where the IV change, implied volatility, was up by more than 25%. So we see here seven stocks today where the implied volatility was up a lot, more than 25%, and where the option volume was significant on a relative basis. Okay, so CLDR, October 23rd, 12 calls, NET, October 16th, 55 calls, implied volatility up 123%, and option volume, 19,957 contracts, representing 109% of the average daily option volume. Does that make sense to everybody? Are there any questions?
Well, you have a few questions about unusual option volume. You want me to ask them now?
Yeah, we might as well. Go ahead.
All right. This is from a new attendee. I mean, it's a basic question. It's Jaden. He's brand new to options trading. I understand why you might want to screen calls for high theoretical edge, i.e. get in the contracts on, at a better price. But could you reiterate why you might want to search for unusual option volumes?
Yeah, so there are a couple reasons. When there's an unusual option volume, there's probably something going on, right? So when you're seeing a lot of volume, probably something going on, maybe an event, maybe the stock is breaking out. Like you'd want to go see what is the catalyst behind so many trades. The other thing is that when there's trading, when there's lots of trading, and if there's volatility and things are moving around, that's where you kind of start seeing more and more opportunities, right? Because it's moving things around, right? And when you're seeing volatility, when you're seeing lots of trades going through, there's potentially more opportunities, more things might dislocate, or more things will diverge from where you would expect them to be. So traders look for unusual option volume for those reasons. What's going on? Is there an opportunity? Let me try to figure out what people are thinking and where the opportunity is. So lots of times people want to see what's going on. And also, if something's going on in one stock and it's justified, you might want to say, well, what is the next stock they might come after, right? Like if they're coming after this solar stock and they're coming after this solar stock.
Well, I was just saying, we've been talking about the solar stocks, the lithium battery stocks, the bio, every day we talk about them, and it seems like it's repetitive. And,
right.
and for Jaden, who may be new, if you turn on CNBC and listen to the Nigerian brothers, that's what they do, right? They try to look for unusual option volume in the market and participate if they feel it's a trade
right.
they want to participate in.
Exactly. Like if you're seeing some kind of trend, like maybe this stock and this stock and this stock, whatever, let's say they're all lithium, right? And all of a sudden you're seeing lots of call buying in lithium, and the calls are way above where you expect them to be. Well, what is the lithium ETF doing, right? Or what is like a similar thing? Like what is it? So traders start to kind of put pieces together. Remember, you're trying to put a puzzle together and position yourself in where you think your odds of success, or what do you think the most likely thing is going to happen next. That's where you're trying to position yourself. Like, what do you think, based on the information you're getting, what's the most likely thing that's going to occur, and how do I position myself to be in a place where the odds are more favorable to me than unfavorable? Okay, so that's why lots of people look at those unusual option volumes to see what's going on, where are people putting money, why are they committing money, why are they taking that risk, and what can I do? Is that helpful?
Perfect. Someone else who's attending for the first time was asking, with unusual option volume, can you screen strictly for out of the money options and pick a notional value above that you want to screen for? Is there any way to do that? They're asking.
So you can do it by delta. So like over here, I could just set here, where's the delta? So if I wanted just an out of the money, right, I could just say, you know what, I want a delta below 30. So basically this is going to just screen for out of the money. So I just narrowed it down. So you see here, Ego, stocks 13. This is a 14 strike, delta 16. Levi, stocks 1580. This is the 17 strike, so that's $1.20 out of the money. Here, YIN 1722. This is looking at the 18 strike, 26 delta. So you could do it that way. We don't have the notional, just the option contracts, but we don't have the notional amount traded in this screener right now. You could go look at the notional from the options chain, but we don't have it. We don't have it in here. So, do you have any? I didn't get to everything. Maybe I'll get to. I mean, I could keep going. Do you have questions?
Well,
Don't-
we do it. We have a lot of questions. Some are based on the topic we were discussing. Others are.
Sure.
Mike is asking. Let me get based on history. If the market ever gets back to crazy vol again, will the scanner only return a few historical points since volatility is super high? I mean, I guess that's
right. So what you're doing is then, right, like when the markets are, let's say all the implied volatilities are high, right, across the board. So there's nothing really to buy. So you could still use those benchmarks on a relative basis, right? Like, well, how high is SPY above its benchmark relative to high is QQQ, right? So if I'm paying 10% over for SPY and QQQ is trading 30% over, well, maybe SPY is not such a bad, in this environment, maybe that could be a pretty good buy considering the things around it, right? So once you're looking at that market where Mike is talking about like overall, let's just say money panic, right? Everything's going down, implied volatility. What do you do? There's nothing to buy. You start doing it on a relative basis. Everything is high, but where on a relative basis, what still looks cheap given the new environment, right? If everybody's paying 30% over, let's say, 20, all these financials, and you find them like these financials are only 10% over, and I think they're going to get pulled down anyway, those could be a buy. So you would still use it. We're always comparing, right, the benchmarks on a relative basis. Does that help? Was that the question?
Yeah, that's helpful. Someone was asking for you to click on this. They want to see the seasonality tab, what that gets you to.
Okay, right. So that was another thing I was going to do. So I'm going to clear this out. So what is a seasonality? So seasonality is just basically looking historically, instead of like 5-day periods, is just looking at a calendar period. So for example, the month of October, right? Like how does this stock perform from October, from the first of the month to the last of the month? How does it usually perform? But with options, there's different days that we're interested. So really, since this option expires October 16th, we don't really need to know how the stock Apple performed between October 1st and end of October, because this is going to expire before the end of October. So if today is October 12th, right, and this option expires October 16th, what really we want to know is how did it perform in that period, right? So let's take a look at that historical seasonality. So historically, Apple, sorry, losing my voice. Historically, Apple today, October 12th, between October 12th and October 16th, in the last 12 years, Apple was up, the stock was up 66.7% of the time, and on average returned 1.3% in that calendar period. Okay, so that's what it's looking at. For each one of these, it's looking at from today to whatever the expiration is on that option. If the option expires, October 30th, it's going to look for October 30th. So here's one, let me take a look. So these are all October 16th. Let me see if I could find something. So let's say, okay, I have them all set to October 16th. So like October 19th. So look from October 12th to October 19th in SPY. Last 12 years was up 83% of the time for an average return of 0.9%. But how do we use that, right? So, okay, great. We know that. How do we use that in our screen? So one thing we could do is set that as a filter and say, look, I want to look for options that have seasonality, whatever that term is, I want that it had a 70% win rate. So then it's going to scan all of them and make sure that 70% of the time, whatever the calendar period is, historically, it was up. Okay, we could also give it a minimum return, right? So like, let's say the median return, we'll just say any positive. But let's go further, right? Let's go further and say, this is what I'm targeting. I think I like this strategy, and I want to target that on average, SPY returns 0.9%. Let's say 0.9% on average based on that seasonality. So I'm going to take a payoff. I'm going to say I want to do an option. Oops, sorry. Let's go over here. Strategy payoffs. I'm going to go to the one next door. Strategy payoffs. And here it is. If the stock does its average seasonal move, right, 0.9, right, this option, the October 19th 355 call, this, it's going to lose 62% of its value. So that one's no good. This one will return 19.6%. So here's what we're going to do. Let's make it easier and faster. I'm going to go here to the stock parameters. I'm going to say, show me, I want a positive theoretical edge, any positive. And I'm going to say, show me the best return based on the seasonality move. So if the stock does its average move, what option is the best one? So, let's do any next 30 days, any option next 30 days. So here it is. Microsoft, the October 220 call, stock's 221.40. If it does its average seasonal move, this option will return 64.8%. NVIDIA, it's looking at the 570 call. If it does its average seasonal move, this option will return 107%, FXI, and so on. So that's what it's doing here. That's how quickly it's going to go through and find you the best option based on the seasonality. So we got that one in. I know that one was a little bit quick, but we're already up against an hour. If you have any last questions,
there are a lot of questions and they're all over the place. What I suggest to everyone is take advantage of the forum. That is a great place to post any questions that were not related to this topic. This topic was the long call option screener, which is a great new feature. Next week, maybe we do the put, or maybe we go deeper into this D. I don't know. Actually, next week we have Jay Soloff on next Monday.
Oh yeah, we have a guest on next week.
And
so next week, Jay Soloff.
Yeah. So great show, everyone on Zoom. Thanks for joining us. It made it a great episode, and those on YouTube Live, also a big thank you for joining us. Everyone, join us in the morning. We do our show 9 a.m. to 9:30 every trading day, and bring those questions tomorrow. We'll try to get to them if we can, Dima. Great show. Thanks a lot, buddy.
Thanks, everybody. Thanks, Will. Have a great night. Hope to see you guys tomorrow morning.
All right, great. Thanks, everyone. We'll see you in